This video is a video on accounting for stock investments when we own less than 20% of the outstanding shares of an organization, and we have classified the shares as trading securities, which means we are going to sell them within the near future, usually 3 months. Here's the problem that you've had available to you, and this video will walk you through the first requirement, which is to prepare a year-end adjustment on December 31st of 2010. So in this problem, we are a U.S. bank, and we have purchased 12,000 shares of Pepsi Inc., which represents less than 20% of the outstanding shares. And when we purchased these shares, we bought them at a price of $16 a share, which meant our initial investment had a value of $192,000. And this problem doesn't ask us to record the acquisition. So when we would have acquired this stock, it would have been acquired at cost, and so we would have a value sitting in our stock investment account of $192. And so what happens is the first year ends, December 31st of 2010 rolls around, and the value of the Pepsi shares have performed quite nicely. They've increased to $21 per share. And what that tells us is at the end of that 2010, our investment now has a value of $252,000, which is significantly higher than the cost. And so now we have to mark to the fair value the historical cost. So we've created this fair market adjustment account, which is a valuation account, which will deal with any changes in the fair market value. So rather than increasing the amount of the value of the stock right into the stock investment account, we throw it down into here into the market adjustment trading account. So the difference between the 252 and the 192 is how much the value of the stock increased, $60,000. So we are going to debit this thing called the market adjustment dash trading, and the reason we say dash trading is because that indicates what our intent is with this stock, and that we're going to sell it very soon. So $60,000 debit, and we have actually an unrealized gain. It's unrealized because we haven't sold the stock yet, and so we would now credit unrealized gain dash income for the same $60,000, and so this would be to mark the trading securities to the fair value, and this is done at the end of every accounting period. So that answers the first requirement of this problem.